Let's jump into our weekly market review. And as always, it's coming straight from MacroOps, our global macro research and consulting firm. And Alex was on a silent meditation retreat for the past 2 weeks, if you're wondering why we didn't have any of these videos either. So if you're interested to hear about that, then make sure you're signed up for the MacroOps list. But let's jump into markets. So right now, everything is breaking out. The S&P formed an outside bar for the month of October. And you know we look at monthly bars because they give us the best signal. So at the end of every month, we get a new print. October's was an outside bar. So this is an IOO pattern, which is inside, outside, outside, which means the S&P is in breakout mode and we should see higher prices this month. So things are looking pretty good for the bulls. Sentiment Trader points out that this breakout coincides with the new high in the cumulative advanced decline line, meaning that strong breadth is behind this move, which you know is important because if we're seeing prices go higher, we want the entire market moving together, not just a few big stocks dragging everything up. So the advanced decline line kind of tells you how the breadth is looking. Advanced decline is just the number of stocks advancing versus declining. And you can see right here, this blue line is the advanced decline line and it's breaking out. So you got a breakout in the price of equities along with a breakout in breadth, both positive signals, especially when they're together. That means this breakout will hold, or it should. It has a higher probability of doing so. And if we look into the data, since 1928, the S&P 500 was 3 times more likely to suffer a 10% decline at some point within the next 3 months if the advanced decline line was not at a multi-year high. So it's kind of a weird stat. But basically it's saying that because the advanced decline line is at a new high, we have a higher probability of just staying up. So when it did break out to a new high, as it did on Friday, there was only a 4.6% probability of a 10% or greater decline within the next few months, and a less than 2% probability of a 20% decline. So this data is just kind of showing why this breakout is so strong and how breadth really contributes to that. So you can see here with these red bars that if the advanced decline was not at a new high, much higher probabilities of corrections happening sooner. But given the confluence of these two signals, it looks like we have some room to run. Another place to look is the mid caps, and they are looking pretty good. They had a breakout from an 8-month trading range, and that breakout included 10 consecutive bull bars, which shows really strong buying pressure. And then you could see right here on this line, there was a big breakdown, but it was immediately reversed. That's another bullish sign. So when you see action like this, the best strategy is to actually buy the breakouts and sell the setup reversals. So definitely good to be a bull here. Recent sentiment surveys show that even those who are the most skeptical and bearish on the market are just throwing in the towel and buying stocks now. The bears are now 65% invested in stocks compared to their average positioning of net 77% short over the last 15 years. So they've almost given up on being bears, which is good in the short term, but in the more long term, what do we know about market tops? They happen when there's no more bearish people, right? Everyone's bullish. Then the thing turns around. But I mean, it's easy to understand why the bears are giving up because really just everything turns around in this market. So if you look at our Fallible portfolios this year, like the All-Stars or the Alpha Rotation, they're underperforming. And there's a few reasons why they're doing that. The first is that in this type of relentless bull market where every dip gets bought, you don't actually get paid for risk control. So you can see right here when the NASDAQ fell, I mean, it's done this a few times this year, right? It's been pretty volatile. Proper risk management says that what do? You respect your stops, right? So you sell to protect yourself in case this thing kept going lower. But the problem is in this type of market, everything gets reversed, right? So you end up getting penalized for having that risk management in place. And this is just what happens in certain types of markets. And you may have the question, well, then do you change your risk management? Like, are your stops just getting run? Not necessarily. It depends how you built your system and your strategy. So in our case, our strategies are tested over 20 years in every different type of regime. So we know that our strategy might not work as well in some years, but overall our returns are way, way better. So you don't try to over optimize a system or a strategy to a particular market because then it's just going to break down when the next type of market comes along. And the trick is you don't know when that next market is coming along. And you've seen that even in these videos that we've been doing, right? With our research and MacroOps, it does change week to week because the market is volatile. Things are getting reversed each way pretty quickly. The second reason the model portfolios are underperforming a bit is because a lot of the signals in the market have broken down, which is once again because of the manipulation that's happening. Now, does that mean those signals are worthless now? No, of course not. In fact, they will absolutely start working again. And again, the question is, well, then don't you want to change the signals? No, not necessarily. Again, it depends on your system. When you have a long-term focus system like ours, you aren't just going to change the whole thing, especially based off a short-term period like 1 year, because you could see our returns last year, they were incredible. But this is real investing. This is how it works. And if you're too short-term oriented, well, you're going to go through a lot of pain. So for me and our team, we're really not worried about the models. This is all normal. When you should be worried is if there's a drawdown that's outside the scope of what you expected. So far, we have not seen seen that. We have not even come close to that. The action we're seeing is standard. But I just wanted to explain that because that's the big trap that a lot of people fall for when they're running their own strategy. Because they see some short-term action, like every dip getting bought, they try to change their strategy and then they screw it up. And at the end of the day, I'm always going to be happy with good risk management because you never know when one of these dips are just going to keep going down. So you'll see in a second here as we continue with this week's research, yeah, we are going to see some bullishness over the next month or two, but we're still waiting for that bigger correction. So a big concern for this market is the Fed surprising everyone with a more hawkish turn. And what we got to watch there is inflationary pressures, right? Because that's what the Fed is watching. So if they turn out to be less transitory than first hoped, then we're going to see a more hawkish approach. So right now with this chart, you could see wages climbing at their fastest pace on record. And actually, sorry, I'll tell you right now what we're thinking for the future. We are seeing that the market is going to go higher in the next few months, right? But also in the next few months, because momentum is fading in this market, and you're seeing stuff like this where the bears are becoming bulls, we are going to see that longer term top happen. So how do you play it? Well, you stay long, but you also stay nimble, because don't be so sure that this next dip that happens actually gets bought up. That might be the longer term correction. And again, it's tough to time this stuff, but that's why you have standard risk control in place. Now, speaking of going long, there are a few stocks that we're looking at. One of them is Teradyne, ticker symbol TER. So they make semi-test equipment, and they've broken out to the upside from their year-to-date trading range and remain in a strong uptrend. So this is definitely one you want to keep on your watch list. You can see this nice little breakout right here. Another stock we're looking at is Spotify. So Spotify really has a great CEO in Daniel Ek. He's actually one of the best in the game. So there are a number of significant hurdles that they need to clear in order for them to generate a significant amount of cash, but it looks like they're making the right moves to get there. Now we still got to do research on this, but if you look at the long-term weekly chart, it is looking pretty good, especially with this recent breakout. So this is another one to definitely add to your watch list. That's it for this market review. We do these weekly, so if you want to see them, make sure you subscribe to our channel. I'll see you next week.